Assalamu alaikum friends, welcome to the last day of AFM revision crash course, and today's topic is reconstructions and reorganization. The topics that we are going to cover are past exam, then financial distress, assessing the risk of corporate failure, other predictors of corporate failure, financial reconstruction and business reorganization. The reason why we are studying the financial distress and the corporate failures are because reorganization are usually done because when a business fails, right? It's not always the case, but most of the time that's the reason why business do reorganization and all. So let us go through the financial distress. Okay, as you can see in your past exam history, this question also comes every year. Okay, and this question mostly comes in question 1 and 3, right? But so it's mixed overall. There is a 50-50 chance that it might come as question number 1, which is 50 marks, or question number 3, 20 marks question. The nature of the question differs when it comes in question number 1 versus when it comes under question number 3. So you need to understand the nature of it, especially when it is under question number 1. That means it's very detailed, right? Mostly if it's in question number 1, they might ask you to show the impact on the financial statement. They will tell you to do lots of calculation. But when it comes into question number 3, the details are less. The impact will be more on writing theories and all. Okay. So as you can see, ratios and performance appraisal, right? We sometimes need to do ratios to see whether the business is failing or not, how the business is performing. Then we have unbundling strategies, impact on the statement of financial position, impact on earnings, impact on cost of capital. The last three are very important. What is the impact on the financial statements? What is the impact on the earnings? What is the impact on the cost of capital? You might be asked to show the impact. Impact means you have to show before the reorganization what is the earning or cost of capital versus what is after implying that reconstruction scheme, what is the impact on the earnings or cost of capital or your statement of financial position. Now let us go to the some reasons why financial distresses. So the 5 causes of financial distresses are: number 1, revenue failure, right? A company might go through a financial distress when there's a revenue failure. Second is cost failure. Then we have failure in asset management. You're not able to manage your asset well. Failure in liability management, right? You didn't manage your liability well, hence you are now facing a problem in paying debts and interest. Failure of capital management. You didn't manage your capital well. Your working capital is not managed well. And you need to understand that this things does not operate in isolation. Rarely they happen in isolation, but mostly they are linked with each other. For example, if you're not able to manage your capital, working capital, it will have an impact on our liability. Okay. Now let us go for assessing the risk of corporate failure. How do you assess the risk of corporate failure? Before that, you need to understand what is corporate failure. Corporate failure means you are unable to achieve long-term return on capital over long-term period. So it leads to insolvency. This is a risk of corporate failure. It leads to insolvency. You become insolvent. Hence, you have to liquidate your company. You will not be able to survive for long term. Then, reasons are generally non-financial. Okay. The reason why there's a corporate failure and all is not mostly financial, it's reasonably from non-financial factor. And it might include your inability to adapt to the changes in environment. One very good example is Nokia. What happened to Nokia? Nokia couldn't adapt to the changes that was happening in the market. And hence, Nokia is nowhere now. Right? So these are some of the reasons why corporate failure is there. Then, the risk of corporate failure can be identified by analyzing accounting ratios. That's why you need to know in AFM the formulas of accounting ratios. It could be profitability ratios, it could be liquidity ratios, right? To see the trend through ratios, you'll be able to see. If you see that your net profit margin is declining over 4 years, you know that there's some risk of corporate failures there, right? Your business is going to suffer over the long term. Not always, you might not have to do ratios always, but sometimes you might have to do to see the performance of the company. And remember these four areas of ratios. One is liquidity, profitability, gearing, and stock market ratios. In profitability ratios, we have return on capital employed, net operating profit margin, gross profit margin. Liquidity, we have asset test ratio, current ratio. Gearing, we have debt divided by equity, and stock market ratios. For example, EPS, your price earnings ratio. Now, other predictors of corporate failure, there might be some other predictors which can help you to predict that there's going to be a corporate failure. Free cash flow analysis. You see the information in the company report, information in press, right? Information regarding an external or environmental issue, a going concern evaluation. And some information may be provided in a form of notes in a case study. So most of this information will be given to you in a case study, right? Whether there is any issue regarding to going concern or anything published in the press, right? Remember that such models only show a snapshot. Yes, it's not an indicator that definitely it's going to be a corporate failure. No, it's just a snapshot. At one point of time only they are saying, okay, this is the performance. So mostly these are short-term predictors. For short-term they can predict. That's why after going through this also you have to do some further analysis. Remember that. In practical world I'm telling you. Further analysis are required. You just cannot rely on what the information that you get in the press. You just cannot do a free cash flow analysis and then say no. No, there's going to be a corporate failure. No, you have to do some other further analysis are required to confirm that it's true. Because what happens, some models they tend to rate companies low. It happens. So you have to be extra careful. Now, financial reconstruction. As I told you, reconstruction is not only for the companies which are failing, it could be for a successful companies also, hence solvent company also. So if it is for the solvent company, what is the objective versus what is when it's a failing company? The objectives are different. So first let's start with the solvent company. The objectives of a solvent company for reconstruction. Number one, improve the capital mix. Why they want to do financial reconstruction is to improve their capital mix. Second, improve the timing of availability of funds. Then options available. Okay, so the options which a solvent company has is different from the failing company. These are the options available. Conversion of debt to equity. They might convert debt to equity. Hence, it will improve the gearing ratio. Or they might convert equity to debt to take the advantage of interest, because interest is tax deductible, right? Cost of debt is always less than cost of equity. So they might convert for equity to debt. Or they might conversion of one equity form to another. That means both are equity, but the form is different. For example, ordinary shares might be converted to preference share, right? Conversion of debt from one form to another. So debt means it could be that you are taking one loan from bond or bond from loan, or loan is of different type, right? With the different redemption date, you're changing to another loan. Now let us go to the failing company. When they do reconstruction, what is their objective? Attracting fresh capital. They want capital because their objective is that they want to survive anyhow. So they want capital. Second, they want to persuade their creditors to accept some form of security because they are unable to pay their debt. So through this, they will give some security to the creditors. Okay, so that this prevents the company from going into liquidation. Because if you are unable to pay your creditor, what happens? Your company will be liquidated, right? So in order to stop that, you do reconstruction. Then what is the options available for this? Options are a company voluntary arrangement and administration order. Now let us go to the procedures when you have to build a reconstruction scheme. Reconstruction schemes are not built in day one. You have to go through certain stages. Okay, so stage number one, write off the fictitious asset and debit balance on profit and loss account. And you have to revalue the assets to determine their current value to the business. When you're doing reconstruction, at that day, you have to revalue your assets. Okay. Second step after that comes, okay, you have to see whether after that if any further finance is required or not, and if it is required, how much and in what form. How much, that also matters, and in what form, that also matters. For example, are you going to take shares, are you going to take loan, right? And from whom it is obtainable, from whom are you taking it, from existing shareholders or from bank or from venture capital. Third, after you have decided, you have to determine the reasonable manner in which you are going to spread the write off, the capital loss. That capital loss has to be divided among various parties, right? How are you going to do that? It has to be reasonable between various parties that have financed the company, for example, shareholders and creditors. Based on the above means based on the amount of finance that is required and in what forms. And finally, after the scheme is ready, you have to make sure that this scheme is agreed by all the various parties who are involved. If they are not agreeing to the scheme, you have to revise your scheme. Parties have to agree with the scheme. Now, let us go to the reconstruction scheme. So, when you're building a reconstruction scheme, you need to take this certain things into account because this will have an impact on certain people. For example, shareholders, ordinary shareholders, then preference shareholders, then debt holders. So, this will have impact on these three things, this 3%. Okay. Now, let us go to the business reorganization. So, we are over with financial reconstruction. Now, we are moving towards business reorganization because the topic is reconstruction and reorganization. So business reorganization means what? Business reorganization is unbundling. Okay, unbundling means you are selling off some non-core business activity which is not very core to your business. You feel that it's better to sell it off so that it gives you more cash, it reduces your gearing, it allows the management to concentrate only in their core business, right? The key objective is to increase shareholder wealth. I have told you from day one in AFM, whatever you do, whether it comes to managing your exchange rate risk, interest rate risk, your acquisition and merger, or your investment appraisal, taking on projects with positive net present value, or business reorganization, whatever you do, main objective is maximization of shareholders' wealth. So now, are you able to link all the part of your syllabus in one under one objective? Maximization of shareholders' wealth. Okay. So, these are the forms of unbundling: spin off or demerger, management buyout, sell off, liquidation. You must have heard about, especially the management buyout, right? This is very common. We are going to study this management buyout in the next slide. So, one example of business reorganization is what? Australian airline Qantas split into two, international and domestic, via demerger. What is the meaning of merger? We went through merger, right? Previously, merger means when two companies join together and become one. Demerge is the opposite of it. One company is becoming two. Okay? But they are held by the same shareholder only. They are controlled by the same shareholder, but now they are two different business, not one. Okay? And you have to know the advantages and disadvantages of all of these four forms of unbundling: sell off, demerger, management buyout. So the next one, okay, and this is the last in this video, that is MBO, management buyout. Because this is very common in reconstruction, reorganization question, management buyout. They often ask a question about management buyout versus management buy-in, right? The advantages of it, how management buyout will have an impact. So these are the four things that you need to study. First is variation. Management buyout could be in many ways. For example, Management buyout, that means you are selling to the management. Management buyout means you are selling to the existing manager. You're selling your business to the existing manager of your company only. Management buy-in means you are selling to the external manager. That manager is not your employee. That's the difference. Okay. Leveraged buyout. Leveraged buyout means you are selling to an external third party. Employee buyout. You might sell to your employee. Out of the two, the first one is very common, management buyout. Right? Now, reasons for buyout. Why do you want to go for buyout? You need to know the reason. Number one, parent company wishes to sell. Simply parent wants to sell. It's their wish because they feel that they cannot control too much, whatever it is. Second, parents require cash. Third, subsidiary might not fit with the parent strategy. Yes. Subsidiary is too small to warrant the time being devoted to it. Because if the parent feels this subsidiary is too small, they might sell it off. Cheaper to sell a loss making subsidiary to its manager than liquidation. Rather than going to liquidation, better to sell to the manager, right? Private shareholders wish to sell out. Liquidity and tax factor. They might think about liquidity. That if they sell out, they are going to receive more cash, hence they'll be better able to manage their liquidity, their cash, their asset, and tax factor is also there. Family succession problem, right? Now, considerations before a management buyout. What are the considerations? Number one, do the current owners wish to sell? Second, potential of the business. Loss of head office support, yes. Head office support will not be there. So, are you willing to uh, lose that support? You have to take these things into consideration before you actually decide that you are going for management buyout. Quality of the management team, it depends to the managers that you are selling this. Do they have the quality to run this? The price, and finally the price. Because if the price is too low, you might not consider for a management buyout. You might go for employee buyout or leverage buyout or some other ways through which you can raise cash if that's your objective. Financing the MBO. This is very important. Out of all the other areas, the last one, the last box is very, very important because questions have come from this area. In an MBO, the managers usually lack the financial resources, right? Because the managers are your employees, right? So there are high chances that they will usually lack the financial resources because they used to depend on the salary that they used to receive from your company. They don't have any other means of having their income, right? So it's very unlikely that they are going to have enough financial resources to pay you. Number two, venture capital. They might consider venture capital, the managers, to finance this. Clearing banks. They might go to clearing banks. Pension funds and insurance companies. Merchant banks. Government agencies and local authorities. The most important is venture capital. Okay? If you have seen. Others are also important, but if you see, the role of venture capital is very important. It's there in your textbook also, you can go through that. So that's it for reconstruction and reorganization. This topic is very small. Okay? Very small. So if you have the key point to remember reconstruction and reorganization is learn all the rules under acquisition and merger. For example, of how to find the cost of capital, what is the impact of the company after acquisition. Here, same way. Here you have to find the impact after you sell off or demerger. When one company becomes two, is it good? Are the cost of capital reducing, or is it increasing? What is the impact on various parties? The shareholder, are their shares reducing? The credit holders, the bank, the venture capital. If they together show the impact on the financial statement, make sure that you can use Excel for that, and you write the original whatever is given to you and then show the impact under different schemes. You might have more than one scheme, sometimes two schemes, sometimes three schemes. So you can make a column accordingly and show the impact, that amount of loan reduced or increased, amount of equity increased or reduced, retained earnings changed. They might show or tell you, ask you to show the impact on the statement of profit and loss. Make sure that you are able to do that as well. There are enough questions on this area already, so you can go and check in the past paper. And what else is remaining? Let me think. Um Impact on gearing, right? Impact on cost of capital, then impact on EPS, right? So make sure that you are able to show the impact on these areas. After you do the calculation, you should be able to tell whether it increased the gearing. You should be able to write, okay? So otherwise, reconstruction is a very easy topic. It's not at all difficult. Okay, so that's it, right? I have ended here. This is the end. Now, best of luck for your AFM exam. I'm sure that you're going to do your best. And make sure that along with my videos, you also do your revision kit questions, you also do your past paper questions. Make sure that you attempt the latest past paper, that is March 2021 paper, right? And see the trend of the past paper, not for predicting questions, of course, but for knowing that this is the type of questions, variation of questions that can come under accusation, merger, risk management, anything. But if you have any doubt, if you want an explanation, you can always uh, message me, right? Through different social medias, on my Instagram, email me, WhatsApp. Okay. So, and if you don't have my number, I usually don't publish my number in public. You have to mail me and I will give you my number there, right? So, best of luck. And another thing, that I will not mark any mocks and all. Okay. So, don't give me to mark any mocks in the last minute, one day before the exam or 2 days before the exam. Make sure that at least 1 week before the exam, you don't give me any mocks to mark, because I will not be able to do it. And it will not be effective for you also at the last moment, because you will not get the time to correct. I will take at least 2 to 3 days to give you the feedback. And after that 2 to 3 days, you will be, coming almost towards the exam. So you will not be able to correct your mistakes then. It will be too late. If I say that this is wrong or that's right, you will get demotivated also, because you should have done it before. I mean, I don't want to sound rude, but that's the truth. If you want me to mark your marks, you should have sent me before, so that at least you get the time to correct. But the ones who have already sent me the mark before, I haven't marked yet, but yes, definitely now I'm going to mark, because I have finished AFM. I have finished the revision series for advanced audit and assurance also, right? So best of luck for your exam, and just release your tension. Don't worry, no fear, and take care. So best of luck.